Good morning, everyone. On behalf of the Czech National Bank, let me open another meeting with analysts. I am delighted to welcome here Governor Jiří Rusnok, who has joined us in line with the tradition for the final meeting of the year. Today you'll be hearing a presentation from the Monetary Department Executive Director Tomáš Holub, who will, along with Governor Rusnok, participate also in the following discussion. But before we get started, let me give the floor to Governor Rusnok for some opening remarks.
Thank you very much. Good morning to everybody. It's a pleasure to be here with you. It's basically my first time, I suppose, in this position. I'm not sure. Anyway, so in order to be brief, what I would like to stress, yes, we've decided to increase the interest rates yesterday, as you know very well. If I can put some main reasons for this decision, from my perspective, I would mention definitely the economic growth continues to be robust enough, in our opinion, and according to our estimates, we are still, let's say, above the potential of the growth. Inflation is above our target, despite in the tolerance band, anyway, in the upper part of this tolerance band, and it looks like that it will be a bit longer than we expected earlier. So it's another reason. The fiscal policy is slightly expensive in this year, especially. Next year, certain amount as well. So there is no any need to substitute the fiscal policy potentially going anti-cyclical. In its own opposite, it's in the pro-cyclical mode. The labor market still very tough. Basically, absolute shortage of labor force. So this, therefore, the pressure of the increase, further increase of salaries and wages, and it will continue as well next year. Despite we are probably on the top of that from pace point of view, nevertheless, we suppose there will be continuous and quite a long-term pressure on this. External environment, the prices in euro area went up, of course, mainly due to the energy sector prices, but not only. There are also in some countries the pressures on the core inflation. The uncertainties, risks are still with us, basically the same, maybe even more. So trade tensions, Brexit, and the newly won the situation in Italy. So there is, I think, reasonable expectations that prices in euro area will also keep the pace. And last not least, of course, the Corona exchange rate, as you know better than me, is quite a resistance to any appreciation in recent months, and it is something which we suppose will stay with us for a certain time also ahead. So let's also give us a kind of window of opportunity to act with normalization of our interest rates. So that's maybe from my perspective the really very short and brief comments of the reasoning of our decision, and I pass the floor to Tomáš.
Thank you, Good morning, ladies and gentlemen, dear colleagues. It's my pleasure, as always, to give you a presentation of our new forecast, which is part of the last inflation report this year. The executive summary of which has already been published this morning. My presentation will have standard outline. I will briefly start with describing key assumptions behind our new forecast. Then I will spend most time on explaining the new forecast itself. And in the end, I will again briefly compare it with the previous forecast. And in the very end, present you our exchange rate sensitivity scenario. So let me start with the assumptions. As regards the external environment outlook, we can see that the GDP in effective euro area has been slowing down, and this slowing trend will continue according to our assumptions. And at the end of 2020, the economic growth should be at around 1.7. So this is still a relatively benign outlook, which is more or less consistent with foreign growth slowing to its longer-term potential growth rate, or only marginally below it. As regards foreign prices, it has been already mentioned by Mr. Governor that at the moment we see a relatively swift growth of foreign producer prices being close to 4% as a reflection of higher energy prices and weakness of euro relative to US dollar. Looking forward, we assume that the growth of producer prices in the euro area will slow to just below 2% in the second half of 2019 and during 2020. This reflects the assumption that global oil prices, after their recent upswing, will start to gradually decline. The increased inflation, not just the producer price inflation, but also CPI, which is now close to the ECB's target, will allow the European Central Bank to stop quantitative easing at the end of this year, but in line with the ECB's communication, we assume that interest rate normalization will start only with a relatively substantial time lag after they stop buying assets, and as a result, the 3 months Euribor will not turn positive before early 2020. But still, this means some upward shift of the outlook relative to our previous forecast. As regards domestic assumption, fiscal policy, public budgets will remain in surpluses of a similar magnitude as in 2017. And ongoing structural budget surpluses, but it doesn't mean that fiscal policy will restrain economic growth. Quite on the contrary. First of all, we assume that real government consumption will continue to grow at growth rates between 2 and 3%, both this year and to a lesser extent in 2019-2020. Nominal government consumption will, of course, be growing much more swiftly because of high increases of wages in the public sector that I will mention later on. And even more importantly, there will be, or there has been, a positive fiscal impulse to the GDP growth coming through government investment. We see a recovery of public investment finance, both from domestic and EU sources, and even more importantly, some boost to private consumption, not just via increases in public wages, but also in some social security benefits. And for 2019, we have incorporated the extraordinary increase in old age pensions that has been approved for next year. So this year we estimate the positive fiscal impulse at 0.5% of GDP, and for next year only marginally lower at 0.4%. So as Mr. Rusnok has already said, fiscal policy is currently somewhat pro-cyclical. For 2020, we so far assume neutral fiscal policy, which of course may change over time, but for the moment we don't have any information about fiscal discretion for that year. Now I come already to the new forecast itself. This is a brief summary. We expect that inflation will stay in the upper half of the tolerance band in 2019 and will then approach the 2% target from above over the monetary policy horizon. The GDP growth has slowed down from last year's high levels, but for the year as a whole and also for the coming 2 years, we expect the average GDP growth rate to be just above 3%, driven mainly by ongoing robust growth in household consumption and fixed investment. It has already been mentioned by the governor that the ongoing economic growth has been reflected in a tight labor market. Even though we see some tendency also of this tightness to peak in the near term. In any case, the shortage of available labor will inhibit further fast employment growth that has to slow down. And on the other hand, this tightness will of course contribute to ongoing increases in wages together with the planned increase in the minimum wage at the beginning of 2019. But still we expect that the wage growth will be slowing down gradually. And as regards the monetary variables, Koruna is still affected by the persisting negative global sentiment, which has led to its recent and current weakness, but the forecast assumes that this global factor will gradually fade in the first half of next year, and the Czech currency will resume its appreciating trend, driven by a relatively large positive interest rate differential with the euro area, as well as the real convergence of the Czech economy. And the forecast is consistent with continued rise of the domestic interest rates towards their long-run neutral level, which is a reaction both to the marked ongoing inflation pressures from the domestic economy and the temporary weakness of Czech koruna, which has been in place for several quarters in a row for now. Inflation in the third quarter of this year was in the end just marginally below our previous forecast, and overall it has not changed much, but there were some offsetting swings and deviations from our previous projection On the upside, we were surprised by the core inflation. And in the core inflation component, we can see an accelerating trend for the growth of prices of non-tradable commodities. There was a temporary summer spike related to package holidays prices, which then got corrected in September. But even abstracting from this temporary swing, there is a clear uptrend reflecting the domestic inflation pressures, including swift nominal wage growth. And on the other hand, there was a correction or a relatively significant drop in the growth of food prices, which, however, we deem as largely temporary, as you will see soon. This is our headline inflation forecast. We expect that headline inflation will peak in the first quarter of next year, still staying in the upper half of the tolerance band, but really close to its upper edge, because we expect both further acceleration of regulated prices and some key components of the market prices at the beginning of 2019, also reflecting the fundamental pressures on inflation from the domestic economy. And then we predict a gradual deceleration of inflation towards the 2% inflation target at the end of the monetary policy horizon. And then we assume or expect that inflation will stay close to the 2% target also during the rest of 2020. Looking at individual components, I already mentioned that there will be some further speed up in the growth of administered prices related mainly to further growth in the energy prices. We've already seen increases in the electricity prices, and we expect that heating and natural gas prices will follow suit, and this will push the growth of administered prices further up. On the other hand, there is a downward impact of discount fees for students and pensioners, which was already seen in the September data and will, of course, remain in the annual figures for the coming 12 months. Then for 2020, we expect some moderate deceleration of administered price growth, reflecting the assumption that global energy prices will gradually descend from the currently high levels, and also koruna will resume appreciation against the US dollar. And this story is more or less also behind the fact that we expect a slowdown of the growth in fuel prices from currently double-digit levels during 2019, and we expect that fuel prices will start declining slightly in 2020. There will be also some further acceleration of core inflation in the short term as a result of the recent weakness of Czech koruna, coupled with producer price growth in the euro area and still strong domestic inflation pressures. But then in the second half of 2019 and in 2020, core inflation will return close to 2%, due to the moderation of the overall inflation pressures that I will describe shortly. As regards the growth of food prices, I've mentioned that we see the recent deceleration largely as temporary. Going forward, we expect acceleration of the food price growth to almost 4%. Besides the domestic fundamentals, strong demand, strong wage growth, there will be also an impact of increasing global agricultural commodity prices related to lower harvest this year in some key production areas associated with the extraordinary weather conditions. Speaking about the domestic fundamentals, we believe that the overall cost pressures have peaked or are peaking at the end of 2019. Currently there is a combination of ongoing pressures on the domestic economy and resumed pro-inflationary impact of import prices, which reflects the recent weakening of Czech koruna together with price growth in the euro area. Going forward, the forecast expects resumed appreciation of the currency, and therefore the import prices should return to a slightly anti-inflationary position, contributing to the expected moderation of the overall inflation pressures. As regards the domestic economy, we believe that we have already passed the peak of the strength of inflation pressures, but they still remain relatively pronounced. At the beginning of next year, they will also be boosted temporarily by the planned increase in the minimum wage. So more or less, we expect remaining quite persistent domestic inflation pressures also in 2019, and then some moderation during 2020 in line with slowing nominal wage growth. This is our GDP forecast. I would say it's moderately optimistic, quite uneventful, because we expect slightly above 3% average growth rate, not just this year, but also for 2019 and 2020. And the main drivers will remain the same as what we observe now: the household consumption and fixed investment growth. Net exports will be contributing negatively to the GDP growth in 2019, and their contribution will be almost neutral in 2020. This is a closer look at the individual aggregate demand components. You can see that we expect that household consumption growth will move between 3 and 4%, maybe with a light slowing tendency, but really not something major, because consumption will still be supported by a strong growth of wages and salaries and other sources of income, including the extraordinary increase in pensions for next year. The investment growth will be a little bit volatile due to currently negative contribution of inventories, which we believe will turn slightly positive next year. But the big picture is that we expect ongoing growth of fixed investment, both in the private sector, where the investment activity responds to the tightness of the labor market and should contribute to growing labor efficiency, and also in the government sector, reflecting the EU funds cycle, but also increasing investment finance from the domestic sources. The export growth was or has been recently weaker than what would correspond to the strengths of GDP growth in the euro area, partly due to some sector-specific developments in the automobile sector, but we have a relatively optimistic outlook for 2019-2020. In 2019, it can also be partly, the export growth can also be partly supported by the recent weakness of Czech currency. But most of the time, most of the forecast horizon import growth will be outpacing export growth because of the strong growth in domestic demand, and as I mentioned, this will result in a negative contribution of net exports to the GDP growth during 2019. This is our employment forecast. There is already some tendency of the employment growth to slow down, and we believe that this trend will continue, bringing the overall employment growth close to 0.5% by the end of 2020. The main reason is the record low unemployment rate, which most probably cannot decline much further, so the employment growth will have to rely on two sources. First of all, some further increases in the labor force, partly related to immigration, partly to increasing labor force participation. And the second small component will be some cyclical increases in the hours worked per employee, but the overall impact will be only small because structurally there is a tendency or trend of the Czech economy to move toward more intensive use of part-time jobs. The general unemployment rate, we expect only a slight decline to 2% by the end of 2020. When we were preparing the forecast, we took the view that the increase in the general unemployment rate, which was recorded in August, was only temporary. This was later on confirmed by the data for September, which was in line with our forecast. So there is no need to worry about some reversal in the downward trend in the unemployment rate, but really the scope for further decline is small. Nominal wage growth, we believe that it's peaking at high levels at around 8% currently in the market sector, and that it will gradually ease. There will of course be some impact also of the tightening or normalization of monetary policy, including the previous appreciation of the koruna and the firm's effort to maintain their competitiveness and profitability. We can already see that profitability of firms has been declining in annual terms. And because in many firms bonuses are automatically linked to profitability of the companies, this may contribute to some tendency of the nominal wage growth to slow down, even though the labor market is still quite tight at the moment. At the beginning of next year, wage growth will be temporarily boosted by the increase in the minimum wage. But in the medium term, we expect that there will be a slowing tendency of nominal wage growth towards the 5% level, which we regard as sustainable in the long run. Of course, currently we see even much swifter growth of wages in the public sector. and the swift growth there will continue also in 2019, reflecting a major increase of wages for teachers and to a lesser extent for other public employees. For 2020, we then have a slower growth in public sector than in the market sector. Again, this is related to the fact that for the moment we don't have much information about fiscal policy in 2020. This is our exchange rate forecast. For the last quarter of this year, we assume the average exchange rate at 25.7 korunas per euro. So still a rather weak level, reflecting persisting negative global sentiment and outflow of short-term capital from emerging markets to safe assets. We to some extent assume that this negative sentiment will persist also in the first half of next year, but will be fading relatively quickly. And that's why the impact of inflation differential and ongoing economic convergence prevails in our 2019 exchange rate forecast, and we have a relatively swift appreciation there. Also in light of the fact that the monetary policy of the ECB is still expected to remain very accommodative next year. And then as the ECB starts its policy normalization process, the appreciation trend in our forecast stops temporarily or slows down quite significantly in 2020. This profile of exchange rate, which is not linear, is also reflected in the profile of the interest rate outlook. The big picture is that the forecast is still consistent with continued rise of interest rates towards their long-term neutral level, but there is the increase in rates is concentrated at the short end of the forecast and at the long end of the forecast, with a temporary broad stability in between. At the short end of the forecast, the rise in rate is mainly a response of the recent depreciation of koruna, coupled with the ongoing strong domestic inflation pressures. The subsequent broad stability in rates during next year is a result of the appreciating koruna, relatively swiftly appreciating koruna amid continuing easy monetary policy by the ECB. And then the forecast expects that the policy normalization by the ECB will be conducive of further interest rate increases in the Czech Republic during 2020, which would bring us close to the policy neutral rate at the end of 2020, even though according to the forecast, we would not reach the 3% level yet on the forecast horizon. As regards, so this was the big picture of the forecast. Now let me compare it briefly with the previous one. In general, I would say that the big picture, the overall story, has changed quite little. The biggest or most important change is later renewal of koruna appreciation, which together with higher producer price inflation in the euro area leads to stronger inflationary pressures from import prices, especially in the shorter end of the forecast. By contrast, the current strength of domestic inflation pressures has been revised down a little bit due to a less pronounced wage growth in the second and most probably also in the third quarter of this year. However, for next year, the the domestic inflation pressures will weaken a little bit more gradually than in the previous forecast, because the previous forecast has not yet incorporated the minimum wage increase at the beginning of 2019. Now we have more specific information about the government plan, and it was added to the forecast, and it makes the wage growth a little bit more persistent for next year. We have also revised up the outlook for administered prices, reflecting higher global energy prices assumed in the forecast. And well, the outlook for the domestic economic activity is basically unchanged. A little bit weaker for this year, but then the changes are really marginal for 2019-2020. And finally, the new forecast contains slightly higher domestic interest rate in the one-year horizon, and I will explain the reasons why. So this is the revision of the inflation outlook. You can see that it's higher by a few tenths of a percentage point in the one-year horizon, and then basically unchanged. Besides the fundamental factors that I've already described, so weaker koruna, higher inflation abroad, higher energy prices. This is also a reflection of higher outlook of domestic administered prices, which is also mainly due to the energy component. The GDP growth outlook, you can see really very small changes. You know that the second quarter of the year was a bit weaker, a touch weaker than the previous forecast, because there was some slowdown in private consumption growth and an unexpected drop in inventories, but the big picture really remains the same. Nominal wage growth, it was also a bit softer, still at high levels, but a bit softer than the previous forecast in the second quarter. And also the leading indicators for the third quarter led us to believe that there will not be any further acceleration of the wage growth in the annual terms. But then we will start going down a bit more gradually, and as I mentioned, this is due to the incorporation of the minimum wage increase. Here you can see graphically the later renewal of exchange rate appreciation that I've already mentioned, simply because the global sentiment, the negative sentiment persists for a longer period of time than was assumed in our previous forecast. And here you have a graphical comparison of the interest rate outlook. As I mentioned, there is an upward shift in the one-year horizon, and then no change from the beginning of 2020 onwards. The main reason of the upward shift is weaker koruna, but it's not just that, and I will use the following slide to explain it in more detail. The weaker koruna here is seen in the green bars, the short-term exchange rate forecast, but it's also partly reflected in the expert judgment component, which includes our assumption that the negative sentiment will not fade out immediately, but will be fading gradually in the first quarter and second quarter of next year. Besides that, the expert judgment also includes the government measures, so the incorporation of the minimum wage increase and extraordinary increase in old age pensions. There is also some upward impact of foreign variables. We have a bit higher outlook for 3 months Euribor starting in mid-2019, and we also have higher producer price growth in the euro area as part of the forecast, while the GDP outlook in the euro area is just marginally softer. So overall, this justifies a little bit higher domestic interest rates. On the other hand, the initial state of the Czech economy pushes on the interest rates in the downward direction, and this is a combination of a little bit softer nominal wage growth, private consumption growth, but also a bit lower starting level of the nominal interest rates due to the interest rates smoothing, the persistence in the interest rates over time. And we also have revised outlook, a lower outlook for real government consumption, even though we haven't changed the nominal government consumption outlook much. There is higher deflator, so in real terms it's lower, and it's having a marginally negative impact on the interest rate outlook. So this was the comparison, and finally the exchange rate sensitivity scenario. This time the exchange rate sensitivity scenario is again different than what we do normally. Normally we just analyze a one-off temporary, non-persistent, unexpected shock to the exchange rate which fades very quickly, but now we are obviously in a different situation. We've already observed a shock to the exchange rate development that has been with us for many months or even quarters. We have to some extent incorporated its persistence in the baseline scenario, but of course in the baseline we do these expert judgments in a rather conservative manner, and there may be a risk, or there is probably a risk, that the negative sentiment in the global markets may persist further. And here in this scenario, to make the difference with the baseline visible, we have incorporated a rather strong, persistent, and fully anticipated pressure for further depreciation of the koruna, which you cannot see it that much in the exchange rate chart, because the exchange rate chart already reflects the fact that monetary policy, if it anticipates this kind of shock, would need to respond to it in a preemptive manner by hiking the rates much more aggressively than what we have in the baseline, approaching the policy neutral level actually not in 2020 but already in 2019, and this would in the end start affecting the exchange rate and limit the scope of the exchange rate weakness. But still, of course, given the strength of this depreciation pressure in the scenario, exchange rate would be a bit weaker than in the baseline, and in the end inflation would be coming back to the inflation target, but a bit more gradually than in the baseline forecast. While the GDP growth in this scenario is basically unaffected, because on the one hand there are looser exchange rate conditions, a bit weaker nominal exchange rate. On the other hand, interest rates are much tighter, so you would probably get a bigger contribution to GDP growth from net exports, but smaller contribution from domestic demand, and those two things would broadly offset each other. And that's it. Thank you for your attention, and I pass the floor back to Markéta Fischerová.
Thank you, Tomáš. Now let's move on to a discussion. I'm sure that there will be plenty of questions that will reflect not only the stimulating presentation by Tomáš, but also yesterday's decision by the Czech National Bank's board to raise interest rates for the 5th time this year. Before asking a question or making a comment, I would like to ask you to always make sure that your microphone is on and introduce yourselves. So, who would like to ask the first question? Viktor Zeisel, Komerční banka.
Viktor Zeisel, Komerční banka. I have actually a couple of questions. First one is related again to FX. We have seen that the G3 model actually sees the equilibrium level, or it seems that it sees the equilibrium level of corona slightly lower than it was communicated before by the CNB that the satellite models do. So would you tell us what the G3 models assumes as the long-term equilibrium path corona, or where should corona in this equilibrium be now? And I have also one question to the sensitivity scenario. What probability would you give to this scenario that it actually is realizing? And one question to the risk, maybe for the governor. The risks were described as a pro-inflationary, all of them, Brexit, trade wars, and so on. It seems that, well, in the short term they are truly pro-inflationary, but in the longer term they might be actually very anti-inflationary risks, and as we heard on this occasion many times, that the CNB looks in the 12 to 18 months horizon. So isn't there actually a risk that when these events realize that it will have at the end of the day, anti-inflationary effect? Thank you.
Okay, I will start with the first two questions. Well, the G3 model, it's not a gap model, so it doesn't explicitly distinguish between equilibrium exchange rate and the exchange rate gap. But the fact that it predicts relatively big appreciation in the one-year horizon, it's clearly not just a reflection of the equilibrium, it's also a reflection of the policy divergence between us and the European Central Bank. The ECB is keeping rates in negative territory. We currently have the policy rate at 1.75. And in a normal situation, without the current global sentiment, this would probably push the exchange rate to a somewhat overvalued level. And here I can confirm that the interest rate path that we have, exchange rate path that we have for 2019, in comparison with the satellite models like the Beer and Fear, it's a bit overvalued for 2019, and then it moves close to the equilibrium during 2020 when the nominal exchange rate is more or less flat and there is some ongoing tendency of the equilibrium estimates to appreciate. So this would be a normal situation in a kind of policy divergence environment. You would actually expect the exchange rate to become temporarily overvalued. As regards the probability of the scenario, as it is presented, the scenario, I would say that the probability is very low, because the strength of the depreciation pressure, which is behind the scenario, which you cannot see, but we know how we cooked it, it's really big. And without further major tightening of monetary policy, the exchange rate will not remain just stuck where it is now, but it would go well above 26 koruna per euro. And I don't think that there is currently such pressure on depreciating currency. Maybe we're stuck close to where we are, and maybe temporarily the interest rate differential is not enough to offset the negative global sentiment. So I don't think that the scenario will materialize as it is, but it of course suggests that if the corona weakness is more persistent than what we assume in the baseline, there will obviously be scope for smoother and faster normalization of nominal interest rates than what the baseline suggest with this nonlinear profile of rates.
Thank you. Thank you, Tomáš. The governor will take the third question.
Yes, thank you. Yes, speaking about the risk, I would maybe use rather the notion of the uncertainty, because we do not know very much about the risk in details. It's very difficult to at all give any quantification of this uncertainty. So speaking about the risk, I would suppose something that. So we are much more focused on these, let's say, short-term, middle-term horizon, 4 up to 6 quarters. So monetary policy horizon, and in this horizon we do see more pro-inflationary potential impact from these uncertainties. You're right, definitely, that in the longer term it could turn into the stagnation or deflationary signs of that. So in our consideration, we much more focus on these short-term effects, and in this respect we see rather, it is not strong, but rather as slightly pro-inflationary effects.
Thank you. Any further questions? Yes, please.
Jakub Matějů, again, Komerční banka. I would like to ask also about the, maybe related to the sensitivity scenario of CZK being weaker and the effects on rates, but now on the shorter end, on the very on the fourth quarter of current year. The market has been talking a lot about the year-end effects, about the expected weakening of Corona towards the year-end related to the liquidity constraints, related to contributions to resolution fund, which, based on what happened last year towards the year-end, can make another $10 to $20 depreciation in CZK. So my question is to what extent you explicitly work with these effects, and maybe you adjust the exchange rate somehow to account for it in the monetary policy decision making, or if there would be some pain threshold, maybe, where you would say, okay, this exchange rate is something which we really did not expect, and this is too weak, maybe 26 in the average of Q4. Thank you.
Tomáš, answer.
We are, of course, aware of the short-term market distortions related to the resolution fund at the end of the year, but from the macro point of view, I don't think they are very relevant. They affect the exchange rate for a few trading days or weeks at most. So we have actually not taken that explicitly into account in the macro forecast. I mentioned that the first quarter assumption is on average set at 25.7. Well, I personally think that we should look through this short-term volatility, which is purely driven by institutional factors and then fades quickly at the beginning of January.
A very general comment. It looks like from these very often discussions regarding the exchange rate, like the CNB and the board is quite more sensitive to the exchange rate level, current exchange level, but this is really not true. We still targeting inflation. Inflation is our hurdle, and of course, exchange rate. It's very important from point of view of the monetary conditions. So in small open economy, we take into account what is going on with the exchange rate, but we do not feel. I would say we are not so sensitive to especially these short-term fluctuations which could occur, of course. And from this perspective, I would rather say that Corona, it's difficult to say it was expected, but it's quite very stable also from the point of view of the fluctuations. You know, it's relatively very low, and that's something which we do not care very much, but yeah, it occurs that, and it's okay from our perspective as well. So first of all, the inflation is our hurdle.
Thank you. Yes, please go ahead.
Martin Polgina, Investments. I'm happy for the last remarks of Mr. Governor, because I have the impression that the central bank is too much focused on exchange rate in its communication. If you look on all the materials, you know, the sensitivity scenarios provided, it basically boils down to some monetary condition index with a trade-off between interest rates and the exchange rate. So I think, and we are all the time stuck to the exchange rate. I'm not sure whether this really corresponds to the reality, to the sensitivity of the economy to the exchange rate. And also looking at the sensitivity scenario, have you really checked, let's say, the assumption of the model in regards, you know, exchange rates, interest rates, with the recent experience we had, or also we have seen in other countries, with the exchange rate pass-through, which has been quite limited.
I will start with very general comment as well, and Tomáš will continue. Yes, as I said, you know, we are very much aware of certain changes which highly probably occurs in some of transmission mechanism between exchange rate, between first of all the interest rates differential, and that's something which we are studying, testing. There is a lot of hypothesis what is going on, because certainly to compare with the pre-crisis time, it's clear that there is a different regulatory environment, different institution environment. So in this respect, there are certain changes, definitely. Nevertheless, it's still, I would say, in the phase of research mostly. The second one, you know, I would say it is maybe a paradox, but in the Czech economy generally, I mean the economic agents, there is a high sensitivity to the exchange rate. It's even higher than to the interest rates, in my perception. Yeah? So it's the reason why we have to follow and observe very closely what is happening in the exchange rate as a significant part of the monetary conditions. Nevertheless, it's valid what I have said. So the first priority, that the inflation target is the first priority, undoubtedly. So that's true. And this technical question, maybe Tomáš will answer.
Yeah, well, Indeed, we do have an internal task force on re-estimating exchange rate pass-through in the Czech economy, headed by our head of research, Mr. Jan Bruha. And I assume that soon they will be able to start publishing the outcomes. Jan is also a member of actually an EU-wide exchange rate pass-through task force, which shows that the issue of exchange rate pass-through is of interest not just to us as small open economies, but also to the euro area countries. In general, those estimates that I've seen so far confirm that the exchange rate pass-through is small, relatively fast, and working in the intuitive direction. So it's definitely less than 10% in the Czech case for short-term exchange rate shocks, but it takes just a few months. And moreover, I would like to emphasize that now we don't have just a short-term exchange rate shock. We have a shock that lasts already for 2 or 3 quarters and is expected to remain in place for some time to come. So overall, you may actually get a bigger exchange rate pass-through in such a situation than just for the short-term swings that you are able to empirically identify in the methods that are typically used. I would also say that well, I understand that we may create the impression that the exchange rate receives a big weight, but I think it's good to go a little bit back into history, maybe go back to the philosophy of the exit from the exchange rate commitment, which was the point of time when we started with monetary policy normalization. And more or less the strategy was to start policy normalization when we have sufficiently strong and robust inflation pressure from the domestic economy, like tight labor market, economy a little bit above potential output, so that this relatively robust domestic inflation pressure would be able to offset expected anti-inflationary pressure from import prices once we exit and koruna starts appreciating. And this kind of story was playing out quite well until May this year, when the exchange rate started to move in the other direction. So we still have the domestic pressure, but the anti-inflationary import price impact is gone, and we actually get some, not big, but positive impact on inflation from import prices. And for me, quite obviously, this was an environment to speed up the interest rate normalization process, in a sense, to take this as a kind of opportunity window, as mentioned by Mr. Rusnok, to go up with the nominal interest rates.
Thanks for the answers. And yes, Mr. Sobíšek.
Pavel Sobíšek, UniCredit Bank. I'll try to switch the focus to a different area. And my question is this. The central bank's GDP forecast is clearly above consensus, not by a big margin, but clearly above. So I would like to know whether there was some discussion about this, or whether someone in the banking board raised the possibility that things may not go as smooth as forecast by the staff. Thank you.
Thank you. I try to remember well, but I have to say that there was no explicit discussion about the GDP forecast this time. I was much more focused on interest rates development and the calibration and intensity of the normalization path. So no, in fact no. Yeah, there was a certain discussion regarding the output gap definitely, which is quite regular, I would say, because, as you know, well, it's not an easy item. There was a discussion how much, according different methods, we are above the potential, if we are at all, and how the potential could be revised backwards once we will know some important statistical facts later on. So this was in place definitely, but the explicit discussion according the forecast of GDP was in fact not this time happened. Yeah.
Lukáš Kovanda.
Sorry. Good morning, ladies and gentlemen. Lukáš Kovanda, Czech Fund. Let's go back for a while to Czech crown foreign exchange rate. Let's suppose further weakening of Czech currency. In that case, do you consider selling out or liquidating a significant part of your foreign exchange reserves, or that's not a option that's not on the table at all? Because maybe in that case there would be an increase of sensitivity of Czech foreign exchange rate on, for example, the differential between rates here in the Czech Republic and rates in Eurozone. So it's an option for you, and if it is, in which circumstances you would do it? Thank you very much.
Okay. You know, we've always said, and it was basically stressed at time of the exit of the FX commitment, that we are anytime ready to act against extraordinary volatility in the FX market. So if something like would occur, we've been ready, of course, we will be ready to act. But of course the question is what does it mean extraordinary? I wouldn't suppose something like that could occur in the near future, but you never know. But what I would like to stress is that I'd say our the limits of pain are really quite, I would say, wide and robust. So do not expect something like that. You know, few tens of hellers of depreciation of koruna will launch these kind of action on our side. So that's something which I do not expect, or the probability of that I see very, very, very low. But we can't ever exclude that action, of course. That's our role, you know, to act against extraordinary volatility or inappropriate volatility, but that's something which we do not suppose in current situation.
Thank you. Mr. Rusnok, yes, please, Mr. Minčič.
Thank you. Good day. So, Ladislav Minčič, the Czech Chamber of Commerce. Let me focus on the labor market, if possible. I have one remark and one question only. So, the minimum wage indexation should be fixed in the law. That's right. But the details are under discussion. It could influence the wage increase in very, very different ways. That's my remark. And my question is related to slide number 18, called wage growth in market sectors. What's about an adjusted growth? Such a line is missing in your graph. Your adjustments could be interesting for us. Thank you. The 18th.
Okay. Sorry for that. It's probably something that we should delete from the legend, because we used the adjustment in some previous years when there was a strong impact of tax optimization on the observed wage growth, so it became very volatile, and so as to avoid the impact on the forecast, we were using this adjusted time series, but now it's a distant past, so the two series have merged and we just forgot to delete it from the legend. So sorry, it's our technical fault, but there is nothing behind that. It's not related definitely to the minimum wage increase. I wasn't too explicit on it. For the moment, what we have incorporated is the government current proposal to increase the minimum wage by 1,200 Czech korunas at the beginning of 2019. We are of course aware of the fact that this is not yet decided, so it's some uncertainty or some risk associated with the forecast for the moment, but we are already so close to the beginning of next year that we simply had to incorporate some number, and we just took the current proposal. Without saying that it's good or bad, we just take it as an assumption.
Thank you. Does anyone have a question or a comment? Okay, it seems that our monetary policy is almost perfectly clear. So let me conclude by thanking both our speakers and the participants for this valuable discussion. And also, because this is the last meeting of the year and it's a lunchtime, please accept our invitation for a buffet lunch and a chat downstairs at the Bank Club. Thanks again for coming, participating, and goodbye.
Thank you.